Welcome to this explainer. Today, we're going to unpack the fascinating and honestly incredibly complex world of how multinational corporations navigate taxes in developing nations. We hear a lot about corporate tax rates in the news, but the underlying plumbing of global finance, that rarely gets brought to light. So, using Bangladesh as our primary lens, we're going to explore the mechanics of corporate taxation, the regulatory gaps, and the ongoing efforts by developing economies to actually secure their tax bases. Okay, let's dive right in.
To really understand the sheer scale of what we're talking about, we have to look at the numbers. According to a report by the Tax Justice Network, in just a single year, British American Tobacco shifted a staggering $941 million out of developing countries and into a UK subsidiary. And here's the kicker. In that subsidiary, it paid almost no corporate income tax. Now, to be clear, this isn't illegal. It's the result of highly complex global tax planning. But it represents a massive, massive outflow of wealth from countries that desperately need infrastructure and public services.
Let's put that into perspective at a local level. That same report analyzed this company's operations specifically in Bangladesh, and they found that for every single dollar the company paid in income tax in Bangladesh, 22 cents that could have been taxed locally were shifted away to the UK. Think about that for a second. When you multiply that ratio across an entire economy, the volume of disappearing revenue becomes immense.
This brings us to a rather provocative finding by Alex Cobham from the Tax Justice Network. He notes that while multinational companies often publicly highlight their role as major local taxpayers, the reality of nearly $1 billion being shifted out of developing economies tells a very different story. It perfectly highlights this massive gap between corporate claims and the reality of how much crucial funding is literally leaving these nations.
So here is our roadmap for today. We'll cover the disappearing dollars, profit-shifting mechanics, the arm's-length principle, regulatory loopholes, the enforcement challenge, and finally, reclaiming the public purse.
Let's start with Section 1, the disappearing dollars.
Now, you might assume this is a problem spread evenly across all businesses, but it's really not. Empirical data from South Africa shows us that a tiny fraction, literally just the top 10% of extremely complex foreign-owned firms, is responsible for a massive 98% of the estimated tax loss from profit shifting. Because of this extreme concentration, standard macroeconomic analyses often vastly underestimate the problem. They just don't account for how sophisticated these top-tier global firms really are.
Which brings us to Section 2, how profit shifting works.
So how do they actually pull this off? Diagnostic studies identify three main channels. First up, trade misinvoicing. This is deliberately over-invoicing imports or under-invoicing exports between related affiliates to depress profits in the host country. Second, the strategic placement of intangible assets like patents or trademarks. This allows the parent company to charge massive royalties to their local subsidiaries. And third, internal debt. This is where they burden local subsidiaries with high-interest loans from affiliates in low-tax jurisdictions, which creates huge deductible interest expenses.
Ultimately, this all basically boils down to transfer mispricing. It's a clever, if controversial, strategy where companies manipulate intragroup prices. The goal? To ensure the profits magically appear in low-tax jurisdictions instead of the high-tax host countries where the actual economic activity takes place. For example, if a parent company charges its subsidiary double the market rate for a service, the subsidiary's profits vanish. And just like that, so does the host country's tax revenue.
Moving on to Section 3, the arm's-length principle.
To combat all of this, the golden rule of international tax law is the arm's length principle, or ALP for short. This principle demands that related companies charge each other the exact same open market prices they would charge a total stranger. It's really designed to level the playing field, ensuring that a transaction between a parent company and its subsidiary reflects true market realities rather than just being a coordinated tax-saving strategy. In Bangladesh, specifically under Chapter XXI of the Income Tax Act, tax officers have 5 globally recognized methods to test if a transaction is truly at arm's length. Depending on the available data and the nature of the transaction, whether it's commodities, distribution, or unique intangibles, they can use methods like the comparable uncontrolled price or the transactional net margin method. So on paper at least, this gives the tax authority the tools they need to heavily scrutinize these cross-border deals. But that leads us into Section 4, Bangladesh's regulatory loopholes. There is a staggering tax differential at play here. By exploiting bilateral double taxation treaties, companies can recharacterize their operational profits as royalties.
For example, historically, tobacco manufacturers in Bangladesh faced a combined corporate tax rate of 47.5%. However, if those profits are shifted out of the country as a royalty payment to the UK, the bilateral treaty caps the withholding tax at a mere 10%. That is a massive incentive to shift profits out of the country.
Furthermore, Bangladesh's tax code lacks several crucial safety nets that you typically find in more advanced economies. There are no controlled foreign company or CFC rules to tax offshore passive income. There are no statutory fixed ratio caps on interest expenses based on earnings, just non-binding debt-to-equity guidelines. And crucially, Bangladesh hasn't adopted comprehensive global reporting standards like country-by-country reporting. This essentially leaves tax officers flying blind to the broader global value chains of the very companies they're trying to audit.
When you compare major corporate disputes in Bangladesh, like those involving British American Tobacco Bangladesh and the telecom giant Grameenphone, it reveals entirely different battlegrounds. BATB's disputes centered heavily around royalty siphoning and treaty shopping using international structures. Meanwhile, Grameenphone's issues were heavily domestic, focusing on SIM taxes and revenue sharing. It really goes to show just how wildly different and complex tax planning and enforcement can be across different sectors within the exact same country.
Which brings us to Section 5. The enforcement challenge.
The timeline of these regulations perfectly captures the enforcement delay. Bangladesh introduced transfer pricing provisions back in 2012. The regulations actually became effective in 2014, yet it took a full decade until late 2024 for the National Board of Revenue to conduct its very first transfer pricing audits, a 10-year gap between passing the law and actually enforcing it.
And this sluggish enforcement wasn't for a lack of trying by individual officers either. It was the result of severe institutional bottlenecks. The transfer pricing cell faced a lack of specialized training and economic benchmarking, and arguably worst of all, an absence of dedicated funding. They literally had zero budget to subscribe to the expensive international corporate databases needed to verify the pricing data that multinational companies were submitting. I mean, you can't audit global prices if you can't see the global market, right? However, a brilliant breakthrough finally occurred in October 2024. Foreign funding, specifically backed by the European Union, granted the National Board of Revenue access to a global transaction database. This instantly empowered the authorities, sparking the first major audits of multinational companies like Procter & Gamble and Daraz. It proves that with the right data in hand, enforcement is entirely possible.
Finally, Section 6, Reclaiming the Public Purse.
Diagnostic studies and international guidelines suggest that to really reclaim these lost funds, Bangladesh has to aggressively modernize its rulebook. This means implementing strict statutory interest caps based on earnings to stop internal debt manipulation. It means introducing those CFC rules to catch offshore holding structures. It requires adopting transparent global reporting standards and establishing advanced pricing agreements to give both the government and corporations certainty long before disputes ever arise.
We always have to remember the real human stakes behind these abstract tax laws. According to research, the $5.8 million in estimated tax loss from just one tobacco company in Bangladesh back in 2016 was enough to cover the national health expenditures for 170,000 Bangladeshi citizens for an entire year. When profits are shifted out, the impact is directly felt in the underfunding of hospitals, schools, and critical infrastructure.
As we wrap up this explainer, we really have to ask ourselves, as multi-networks grow increasingly complex and digital, how must global tax cooperation fundamentally evolve? Because until the rules of the game are equitable and fully transparent, developing nations are going to continue fighting an uphill battle just to receive their fair share of the wealth generated right within their own borders. Thank you so much for joining me, and keep questioning the mechanics of the world around you.